crazy markets, John. What aren't we going to talk about?
Well, we're going to have to trim back a little bit. What we're going to try to do, and we'll probably get off track, is the market's moved, and it's moved a lot. Now what can a guy do? What's useful information in this market? That's what we're going to try to hit this episode. It's going to be soybeans. It's going to be corn. It's definitely going to be cattle. Definitely wheat. Try not to get too, distracted with all that's going on. But very volatile markets. Lots to talk about.
Welcome to Hedge Heads, where hosts John Prischmann and Ryan Tungseth discuss commodity markets, hedging, and anything related to trading futures. Remember, the risk of loss in trading commodity interests can be substantial. These are opinions only and not trading advice. While no one knows where the market's going, they're not afraid to share some ideas.
Well, John, we went from spring right back to winter with a little March snow this morning.
Yeah, and I think it's just us talking to the guys in Iowa and everybody. Nobody's getting what we're getting. We, just when you get happy around here, they punish you. That's just what it is. But planting's right around the corner. You can feel it.
Oh man, I loved it because I got to spend all morning pretending I'm a farmer on my John Deere, clearing snow for an hour straight, just driving the John Deere back and forth around the neighborhood. Is there anything better than riding your tractor?
I put a real half-hearted effort shoveling snow in front of the office here today. It took about 30 seconds, and it looks like that.
I noticed.
But I was catching up on sleep because these markets were insane. I think I went to bed at 1, got up at 4, and was in the office by 4:45 on which would be Monday morning. Yeah, when you get markets like this and chances like this, I feel like you should be watching the market, especially if you're into the markets, you have hedges on, other guys need hedges on. Like, there was so much opportunity in such a little window, it was kind of unbelievable. Now, that being said, you feel like that dream where you're running and you're trying to get away, or you got 10 things to do and you're not getting anything accomplished. That was Sunday. It was fun to the point where there was lots of action, but you can't get everything. So this brings me to, that's why those orders should be in at the elevator. Like, there's guys I talked to today that had them in, happy. Guys that didn't have them in, not as happy. Like, there's definitely two different camps. It feels like a lot of orders were in there, but this is the kind of market that is textbook why those wish orders were in there. Even on Friday, before the weekend, the war had been going on, you could put your wish orders in at the elevator or your grain, wherever you're selling your grain, and, just in case it intensified over the weekend, and it did. And oil was up a lot on Sunday night, so a lot of those orders did get triggered. But the point is,
coulda, shoulda, woulda.
Coulda, shoulda, woulda. You could also got filled on those orders, and then we could have been up a lot more beyond that the next morning. It's not like, but in this instance, time was of the essence, as often it is. It's usually in the summer though, and not in March. But there's guys that definitely marketed. Feels like a lot of grain's going to move into the commercial elevators. You took a picture of the corn pile on the way home, and it was tested your driving skills. Maybe, kind of taught a guy maybe you shouldn't take pictures of corn piles.
I do highly recommend not trying to take a picture of a corn pile well on a corner, well next to a semi on the freeway, but I have not seen the corn piled at that elevator at this time of year. So my point was, I was sending you a picture saying, obviously guys are selling.
Usually you see that at harvest, and the pile outside slowly disappears. This is in Barnesville, Minnesota, on the way to Fargo from Fergus. And yeah, you don't usually see the pile reappear.
Right.
So grains obviously are going to move on a rally. What I don't like about this rally is corn didn't want to participate at all. And it goes with my theory that they know what's out there and they don't want to pay you. Although the funds have been buying a lot of corn, that's not where their concentration's been.
Before we dive into that, because I do have a corn point, but I think we got to talk crude first, because I know when I looked Sunday night, it was up like $29. You look at the chart now, that's the ugliest spinning top on a chart, shooting star, whatever you call it.
You're gonna have to rewrite one the Japanese candlestick,
ugliest candlesticks I've ever seen. But who sold that thing down $29 up? It was then down like 11, finished close to where it opened, but now it's been down $11 today.
And that's a great mystery. You know, was it the GameStop generation, as I call these guys? Was it the Robinhood people on their phone, coupled with Wall Street, coupled with other people that have never seen oil but are reading headlines? Was it the collective that got us there? Was it the panic? Was it real? Was the sell-off real? I mean, who knows? But without a doubt, you saw a historic swing that you won't probably ever see again in your life. Well, never say never, but that was something that is exceedingly rare.
The only thing I know is it takes some deep pockets, and the only person I can think of with that deep of pockets is my Uncle Sam.
Yeah, or be one of my clients on vacation, and he has no idea it's going against him, and then by the time he looks, he's up a pile of money on an oil short. Go on vacation to Mexico and ignore it too. No, actually, that's the worst advice. It's a market that needs to be watched very, very closely, every tick, and now almost impossible to get involved with. There was guys with oil.
What side you'd want to be on at this point?
Yeah, I don't know that if you look online, first of all, if you're looking online for your trading information, it's getting better. Like, you're getting better numbers and charts. It's for macro moves. Like, I think that's improved a lot. But if you're looking for real-time trading information online, you're going to be in deep trouble. I mean, you're not going to do well. And I think that there's so much stuff online right now that you could convince yourself of anything. Twitter is probably as bad as I've ever seen it. I don't know about you. Normally you go there and that's where breaking news is. Yes, there's a lot of junk and you have to filter what you believe and what you see, and you have to verify. But I find myself going back to CNN, Fox News, and whatever MSNBC is called now. Just just to try to catch up on what actually it's gone full circle. I'm back to cable news, which I find crazy because you could count on online kind of, the legacy media being behind the story, and for good reason. They're confirming stuff, and they're trying to make sure that they're getting the right story out. So they're going to be behind a guy on Twitter that is putting stuff out there that can put anything out there without any repercussions. So it's kind of a double-edged sword online, but the Twitter, I don't know what's going on there, but it's unreadable. And it's not just stuff I don't want to read. It's just like, it's not even AI. They actually cracked down on that fairly quickly. I don't know if you noticed. You're hardly seeing any fake AI stuff.
I don't know about that, but there's it's plenty, better than it was.
But the war stuff, I think that they did crack down on that fairly, because I don't see it anymore. So it gets to be very confusing, and that translates into confusion for the markets. And I think that's really what you've been seeing. What was real and what wasn't, we'll never know. It was a Sunday night. It was it's probably thinner than what normal. I mean, the volumes were going to be huge, but I'm just saying that's how you get a $30 swing. But that's where all the grain opportunities were. Now, quickly to the $1 million question: is that it for the grains?
Well, I mean,
for oil.
Before we answer that question,
can we answer that question?
Well, we can't. Before we throw our best shot at that question, let's jump to corn first, because I want to talk. You mentioned the corn didn't really follow, but man, I mean, we spent 4, 5, 6 episodes talking about those 470 calls in July and September.
Yep.
And I know quite a few guys who are very happy they did that. Yeah,
and the reason why we're bringing it up is because we weren't buying those, and we never recommended on air to buy them. These are private conversations. If we recommend stuff. But, the idea was that it was going to get confusing if corn got up there. I was thinking more like it was going to be a wet spring. We don't know what's planted, and, or a hot and dry forecast. And then all of a sudden we'd be at 470, 480. Yeah. And at that point, if you have a call on that you bought for 14, 15 cents, you can let it go and you can market your stuff. And then you still have that call on to provide that upside in the unknown.
Yep.
And it worked perfect, other than you had 5 seconds to decide on whether you wanted to keep that call or not.
But we've been talking about that too.
But that's the reason why we did it. Yep. In the confusion, it makes it easy to market. They're called courage calls. I'm not always a fan of them at all. Throwing good money after bad money in a bear market, it was even tough. And did I buy piles of them and make piles myself? No, it was an idea to get out there because we were talking about how marketing is so black and white nowadays. Either you sell corn or you don't sell corn. And that's why a lot of markets get missed. If you have something that gives you a little more confidence to get it sold and still have that upside open, with limited risk, which is the magic combination. The only other thing that people want is for it to be free.
Right.
But that one's missing. It does costly. You give up a little bit of premium, but you have no risk beyond what you pay for that call. And then you have your upside wide open on the futures. And that, we're trying to really make it easy to understand. It wasn't a bullish strategy in this particular case. It was that it was bearish. And then if it does come up, we wanted to unload as much as you had on for calls and still have that upside open. So it's buying calls on a bearish strategy. And I don't even know what you would call that. Other guys are getting creative. I had, basically this is an accumulator contract, but it's not at the elevator, selling futures, selling a call, selling a put at the same time, which is very similar to an accumulator. Guys are pulling out all kinds of strategies. My problem from where I sit or where we sit is it's hard to get this information out in a timely manner when oil's swinging around $30. I mean, it's impossible.
Yep.
The guys that called, it was a wide variety of stuff that happened, and guys that didn't call, they might be laughing later. Maybe this wasn't the marketing opportunity. Point being is there's nothing but confusion in the markets right now. Why are beans up 7 when we have a bearish report? Wheat's down 15, corn's down 7, and then you see the 11 o'clock a bearish report comes out for beans. More beans than we thought. More beans in the world than we thought. More corn in the world than we thought. More wheat in the world than we thought. Yet beans somehow, with oil down 11 and bean oil going down, is the ones that says, hey, I have to be up no matter what. So this is a very similar pattern that we've seen. These guys that have bought beans, and they bought a tremendous amount of beans, 200,000 contracts net long for the funds. That position is incredible, or they're near 200,000. It's hard to know where exactly they are,
yep.
But it's near 200,000. We've only seen this in the drought. We actually saw this earlier this year, as a matter of fact.
Yeah, we did. It was the October or September.
When the China deal first came out, they got 200,000 long. Then they went to almost even, in a very short period of time. And then now in another short period of time, they've done 200,000. But that's a very rare number. You don't see that extreme of position very often. So one would think, well, they must have a very good reason. It's not apparent to anybody.
Because the algo said buy.
Yeah, the algo said buy. No, when you look at the bean oil, and I sent you that chart before, the bean oil price at the Gulf, which was put out by Susan Shroud, I believe is how you say her name. Excellent information online on Twitter, by the way. She had a chart out, and it was the soy oil and palm oil prices versus the rest of the exporting world. We're so far above it is kind of unbelievable. That's soy oil. Then you look at soybeans versus like Brazil and Argentina, and it's an incredible gap as well. So what does the U.S. soybean market we don't know? I don't know, but they're betting a record amount on the long side in a very short period of time in the oddest time of year to be doing this. Right when all the world supplies that are much cheaper get to be available for export, this is when they make their run. I mean, it's like the same position as in the drought. It's kind of unbelievable. But for the insiders on Thursday, we'll talk about the opportunities this is creating. That's the side I'm looking on the hedge side, on the spec side in soybeans. And is there opportunities? Absolutely. Are we involved in these opportunities? We are. And you're going to have to call or email, and we'll kind of go over some of them. The insiders know what we're talking about, and then there's more coming. I didn't put an insider out yesterday. I don't think he can. I mean, when the news is changing,
what would you have said?
Yeah, when the news is changing, like every 5 minutes, it's going to be old, even if it's like real-time audio. Yeah. Sure, we could recap markets and stuff like that, or you could listen to the other thousands of people that do that every day. But we're trying to we're seeing these moves. What's standing out at us? Corn, we're talking about. Beans are standing out. Beans are flashing a million red flags here, and that's something I think that I really think is important.
Let me ask you a question on beans. I'm sure you got the answer.
We'll see. I at least can.
Everyone loves talking about gaps and how all gaps fill.
There's gaps everywhere.
Gaps are going to fill. Well, that gap at 1140 has been sitting there a long time on beans.
1040.
1040. No, it's 1140.
Is it 1140?
Yeah, there's a gap at 1140. There might be one at 1040 too, but how come no one's talking about those fills?
That doesn't count. That's a bear gap. That's a bearish gap. That would have to go down to fill it. That's so people don't like talking about that.
It doesn't count. You're right. There actually it's 1070 and 1140.
Yeah, so
there's two gaps there.
There's gaps everywhere in all these charts. Cattle, there's gaps there. There's island gap. I think there's an island gap in cattle. I may have got filled in that. I mean, I haven't had a chance to keep up with any of this. I barely got any sleep. But I'm excited because we were complaining for 4 months, 5 months, maybe a year and a half, really, with a little flare up there, how bad and boring these markets are. And be careful for what you wish for in commodities because it went completely insane to where you got to be exceedingly careful every minute of the day.
So what I love is you and I chatted about the podcast on Friday and some of the things that we were just making notes of. And I said that I had two short option strategies that I wanted to talk about. They were past, but things that coulda, woulda, shoulda done that you could have looked at. And this was on Friday. One of them was cattle, where there was a serial put you could have bought. So it was on the what contract it would have been. It was on the April contract, but it was the March put was going off. And it would have worked beautifully, but it was an example of one where you have to be there watching because you got that one day.
Yeah.
Right?
That's
and you got that one time.
Yep.
And it would have worked, but you need to weigh in on those short-term strategies. Can I sit here and watch this? And what's hilarious is I don't even remember what the other one was because so much stuff blew up Sunday night and Monday.
It is
that
hard
it
to
wasn't
keep track
even I remember that cattle one just because he said cattle, but what we talked about on Friday 100% turned around in 24 hours of Sunday and Monday.
And we're likely to look at a scenario like that again with all that's going on. You have the JBS strike in Colorado, Greenlee, Colorado. That's been out for a while, but it might be official here pretty soon. But what a pattern, now that you bring up cattle, that we have noticed in cattle is that puts can work now. Before you buy a put, you might as well just go outside and light that money on fire. It was just a roaring bull market with one big downdraft, but in that big downdraft earlier, their puts obviously dominated. But beyond that one time, you couldn't get in and out of puts and make money. Now this is a market that if you time it right, puts actually do work here. It's not just the call side. So it's a maturing bull market is what you have.
I just remembered what the other one is, and I'm now extremely kicking myself.
What's that?
It was an oil call that I talked to you about. I talked to you about an oil call Thursday because last Thursday night, and it was the third day in a row oil had done this, so this is why you watch your markets, right?
Yep.
Oil was down $2 after the close of the market when it reopens. 3 days in a row, it had been down a couple bucks, and then it was up $8 or $9 on Friday morning. And I called you and said, why do we not take advantage of patterns like this? This is a short-term thing. This is the other short-term thing. Let's maybe make an episode about what we look at for short-term options.
Oh, yeah.
Was the discussion we had.
So
now I am really kicking myself because I forgot that it was an oil call that I was totally going to buy on Thursday night and didn't. I should have had that Sunday, John.
Yeah, no, it's all
coulda, woulda, shoulda.
We were gonna talk about how so this goes back to corn is where the conversation started.
Yes, absolutely.
It was that when I was getting calls at harvest time, I need to sell, I don't have storage. There was two distinct camps, and one was I want to buy March calls, and the other camp was which was my camp, the other camp,
yes,
saying I think in a 2.1 billion bushel carryover where there's likely to be carry and the front's not likely to lead. Now it's not always true. The front can lead even in bear markets, but that September was the better choice and safer choice.
Yep.
And I had accounts that did both. Like their advisor or whoever said, hey, I think he told me to buy all March. And I talked him into some September saying, hey, it's actually less risky, but it's more out of pocket. And the less risk came from the March all expired worthless. Every single one of them.
They did, yeah.
Yep. And now the Septembers didn't. So had you chose Septembers over March. And the whole thing was that I like to buy time, because if you could be right in your move, and if you run out of time, you're not a part of this deal.
Yep.
And then your point was the oil, like the short-term stuff would be a good example of like a real short-term stuff that would have work that can pay very good if you time the market right with an event. And that's kind of where it all came from. But yeah, there's so much has happened. It's hard to keep track of all this.
Those things only work if you are the one sitting in front of the computer. I can't call all my clients and say, this is working now.
Yeah.
Right. You have to be involved in the markets for some of those immediate short term. And that, to your point, is why we look for time.
Yeah.
Why we recommend time, why there's room in there because of moves, not just in the March versus September, or I still like July, but still has time, because there is time for those things to work and there's time to get in and out.
Yeah, and I look for, like, if you're planning on soybean puts, let's just use that for an example. Like, and I mentioned the fund position's 200,000 strong. Now, how often do they hold that position with that extreme? Not very often. So I'm moving my time frames a little shorter for two different reasons if I'm looking at downside in beans right now. And that would be the that it's expensive to buy a lot of time in soybeans. You have inversions in years maybe that they're not warranted. I shouldn't say an inversion's an inversion, but do we need to be 60 cents above July, above November with this demand we have? Not necessarily. But this is not on the hedge side. This is more on the spec side, because I'm not saying hedge your new crop with the old crop futures. I'm not saying that at all. What I'm saying is they generally don't hold this extreme position. So I wanted something. At first, when beans started going up, I liked May. I have a May in my account, May options in my account. But now, as it's kind of matured along the way and it's become apparent these guys are really defending this position, I'm looking at more time. And all of a sudden, July is a lot more attractive to me. Mm-hmm. Now, I'd really want September, but yeah, time, when you're fading a market, I like to buy a lot of time. But I've had people buy very short windows and do very well, because the advantage of that is you spend very little. You get a lot of leverage for a little bit of money, but those windows are hard to hit. Otherwise, everybody be doing it.
You better be right.
Yeah, so I like that large window. I could be wrong forever. I'll fishing and then, doing whatever I do, being wrong. And then one day you're right and you're the hero again. That's why I like that. It's forgiving.
You're reminding me of a story of my first year working here, John.
Yep.
And just a reminder, that was 8 years ago.
That's time goes fast.
Which is crazy. I know. I was thinking about that the other day. But my first year working here, I remember sitting here. I was working on options. We were doing option pricings. I think at the time it was soybeans. And I came in one day and I'm like, did you see the market? It was down like 70 cents that day. And you say, yeah, I looked at it, and I said, I had a couple options on. This was like my first good win. And you looked at me and you go, oh, you know what? I think I have 5 on. I should go check that. Yeah. And I remember just in my head thinking like, oh, I wonder when I'll get to the point where I have so much time that I forget that I have positions on even.
Yeah. I'm definitely not there right now. It's been a lot tougher markets, but back then things were moving and it's easy to forget. I've seen $12.50 options go to 5,000 soybeans before. Or 25. Let's not be super exact, but 25. Sure.
Yep.
Half a cent, full cent, call it penny, call it 50, whatever you want to call it. I've seen those turn into, $5,000 to $10,000 options and beans. So never, if you have enough time, even if it gets to be worth hardly anything, it can be very, very profitable. One advisor a few years ago had put out, and I think this is like 4 years old. I think or 5. It's past the. They were buying meal puts, like they were advising their clients to buy soybean puts in a big bull market. And they started this first layer, at whatever level. Then if it goes up here, buy more, goes up here, buy more. And like they did this, and I don't even remember what month it was, and it looked hopeless. And then all of a sudden, one day, so they had, 5 different layers. Let's call it six, 7 options total. Some guys a lot more. But then one day it fell. And all these worthless options, except for the ones they've gotten near the top, those instantly were in the money. But even the worst ones of them all, in the end, actually made some money. So that's why I like time. Yeah. You, as long as you have that time, you're in the game. The March guys ran out of time for corn, where if they would have bought a May call, it would have worked, but March didn't work. So it's not about being right or wrong. It's just about trying to pick the appropriate windows for what your strategy is. And that's something that's not talked about a lot. And I think it's super important, especially for hedging. If you're just protecting, I have a lot of guys that like to protect windows, but they ended up buying 3 or 4 options where you're more out of pocket and you're paying us, where you could have just had one for the same price. But anyway, that's a whole nother episode.
Well, and that's a whole options episode, because options aren't, so many guys who I work with only want to know the cost of the option.
Yeah, that's big. That's the first question.
Is such a small portion of the option, the strike price, the time, all those things. Yes, you got to have the money out of your pocket. Like, you got to be able to afford it.
Or what's the cost if this goes down on you?
Yes.
That's really where the focus should be. And we do preach this a lot. Like, giving up some of the bottom line to ensure that you get this bottom line is good. The main argument for people not hedging in the latest environment is none of it's profitable.
Yep.
And I understand that point, and that's why for episodes we have too much to talk about, and we even if we're a little scattered, we're trying to give useful stuff that you can use in this market, not just a simple market recap that's going to be old in 5 seconds. But it's we'll have a whole episode devoted to this instead of getting off track. We'll talk about it maybe next episode if things slow down a little bit. But super important for hedging. It's just as a matter of fact, let's apply it to what's happening right now. Guys got those orders filled in. A lot of corn got hit at the elevator. Hedge to arrive for next year's new crop corn. Now the question is, do these people that did this, and they're all going to have different opinions and different ideas, do these people want to reopen that upside with September calls? Let's say corn pulls back like it is, and the September calls become attractive again. Something that you can own for 13, 14 cents going into the summer. The big decision is, do we want to reopen the upside on some of these sales, or do you want to make the sale final? And that's really up to the producers. So those are the conversations we're going to be having now. Other conversations are still about wheat. Wheat's fallen, but it's still very high for wheat. Is it worth it to buy a wheat put and protect it up here? Other conversations are going to, a lot of conversations are going to be about soybeans for me. Is there opportunity, and are puts worth it up here? It's the one market that really hasn't fallen at all. So they're not all about recovering the upside, but, is it worth covering the downside, and later is it going to be worth covering the upside? We're in a very fluid market. I think even by the time you hear this episode, things might be a little more apparent. But right now, it's just take it day by day and try to navigate it. I'm enjoying this because it's like figuring out a puzzle. This is what it used to be like all the time. Well, not $30 swings in a while all the time. But I mean, these kinds of decisions in grains. Lately, it's just been, well, everything's under the cost of production. What are we going to say? You know what I mean? It's now we have the old markets back. I hope it sticks around. I don't like the reason why it's doing it, but it is the markets, and we're just, we're talking about hedging. Of course, nobody wants war. But I think that there's a lot of volatility that's going to come in the days ahead of us too. And hopefully, a guy can use that to his advantage in all this hedging.
Yeah. Yeah. And I mean, it's the hardest part of what we do, I think, is that when there's so many markets moving and so many things that can affect outside things, they're trying to figure out what we're going to talk about in this, but also, like, how are you going to make these decisions? it just become, well, one, it's more interesting for us and fun.
Yeah.
But two, it is harder to make those decisions.
Yeah, and I think the biggest one now is after all these sales are made, and you see now that sales final, and there's nothing wrong at all with making these sales that are profitable levels. That's the whole point of it. But what do you do now? And I think that's really where the fun begins and the planning begins. Is there opportunity? Are we going to get involved on that side? We don't know. I mean, the market could be up a tremendous amount tomorrow or down a tremendous amount. These are very unpredictable. But what it'll do is it'll set up a guy into that decision. Let's say corn does come off 25 cents here. At that point, we'll have to decide whether we want to re-own some stuff for the upside. And then all that. And just the planning that goes into it, it's just we haven't had markets that have been moving. I still don't like the way corn's acted. It had, 3 days up?
Yeah.
But it is still better than where it was. But they're providing tremendous opportunity. And if that wasn't bad enough to keep track of or hard enough, the cattle is changing rapidly as well. That's a market that needs a lot of focus. That's something we've been talking about for at least a month now at the end of every episode, how you need to be talking to your advisors on cattle and what to do there and protecting them. Cattle are extremely vulnerable up here. There's a lot of things that could end it, and it's never the low supply that ends stuff. It's always something else. Like in the summer, in a drought, the lowest supply, the highest price doesn't come on the lowest supply. It comes on the perception of the lowest supply. In cattle, it kind of has come on the lowest supply, but something's going to come along and knock that off the pedestal, whether it's the oil price going higher or the JBS strike. It just keeps on nicking up that market till eventually you're going to see expansion and it's going to fall, and you have the government actively trying to get beef prices down. So if there's ever a market that needed to be looked at, it's cattle right now. No market ever stays up for good. But like you can just tell in this episode, we're talking about a lot of different things. There's a lot to talk about. There's a lot to fit in. There's a lot of opportunity. That's why I was up at 4 a.m. Other guys probably didn't even sleep that night. But I have to say that was one of the wildest things I've ever seen. And if it was easy, I would have made a ton of money in oil. It's not easy. It's just the opportunities. Here's the way I describe it. Like the markets that we have, you're fighting tooth and nail for 200 to 500 per one that you do per lot. Mm-hmm. You're fighting for that money, maybe for weeks, maybe for hours, but you're fighting for it. When this stuff happens, $500 and $1,000 bills are falling through the cracks everywhere. Yeah. There's pure chaos. If you're able to spot it, you can profit at it. It's not easy, and you also can lose that money. But my point is, with volatility comes opportunity without a doubt. And guys that are prepared for it generally do better than guys that don't. I find that volatile markets I do well at. But I tell you what, in the past, there's been plenty of volatile markets, soybeans, I won't name any names, but soybeans that have not been kind to me. I think I've gotten wiser with age and caution. I'm going to leave everybody with this, and then we'll let you finish up. Be very cautious in these markets. No one has any of the answers. They never do, but these are even more unpredictable than ever. But they do provide that opportunity, and try to use these markets for that.
Absolutely. What I would say to wrap it up is that what we fall back on, this is why you plan.
Yes.
Right? You want to have the plan in place. You want to have an idea of what you want to do, because like you said, Sunday night, it felt like you're spinning your wheels and not going anywhere.
Yep.
If you were only worried about one operation versus your 40 client or however many calls you're making,
yep,
it would be way different. And so if you had that one plan in place, like you just execute it.
Yeah.
And that's where you need to be, because you can't predict these things happening.
No, and incremental sales on the way up in markets like this is a good idea. You don't need someone holding your hand when you get this opportunity. You know what I mean? You should have this planned out. You might have gotten advice from an advisor, but there's plenty of guys that I talk to that had their own ideas, their own levels, and they put them in. And really, there's no excuse not to be getting a piece of some of these markets, other than greed. And you know what? Sometimes greed pays off. What if oil goes to 150 and 200 and things go not the way they think? These sales are going to look silly. So I'm not like puffing my chest out saying, everybody should have all these sales.
No, and it could easily change tomorrow.
It can change tomorrow. And the guys that don't do anything might come out smelling like a rose, but more often than not, they don't. That's my point, is that generally speaking, using these rallies on these types of geopolitical events historically have been a very wise idea. I'd say probably the hardest one was the Russian-Ukraine one, because that was a grain producing region, very important, and and the ports were very important for shipping it out. I'd say that was probably the toughest one to navigate, but you will notice the highs did come shortly after that happened, and it worked its way down over the next couple of years. It never did take out those old highs. Very likely to happen in this situation too. The only question is this going to heat up more, or is it calming down? And if you go online, you're going to get more confused than ever. You can only take it day by day, and that's all you can do, and know that everybody doesn't know, and be very cautious. And I've said it a few times, but that you need to not be taking tons of risks in these markets unless you're really well versed in these markets, and certainly don't believe anything you read online, especially now. A lot of stuff's being put out for a lot of different reasons from a lot of different countries. So it's very hard to trust anything. It was already hard. Right. Grain Foreman, though, really quick. This is at the very end. A guy on Twitter, when I say there is good information, there is. He's got this cool new map. He's got this new stuff he's working on. He put it out there. It's going to be like basis maps, kind of these heat maps in the U.S.
Cool.
Well overdue. I hope that he gets it all put together and it works great for him, because it looks great, the little that he has put out on Twitter. That's going to be super helpful for marketing, and we'll be talking a lot more about that. Go check him out, Grain Foreman. And that's his handle too, I believe.
We'll tag him on Twitter. Follow the Hedgeheads X account, and we'll tag him on our post.
And then Theta Farmer, I've been messaging him and texting him quite a bit. We agreed to disagree on Sunday night, but so far it's been a fun little competition, to try to figure out what this is going to do. And he of course loves these markets. He's Mr. Volatility, so a lot of fun conversations lately with a lot of different people. But the markets are awake now, and we're probably just beginning in all this stuff. I hope that was an end.
Right.
Well, I also hope that there's not worse war.
Right, exactly.
Not, what I mean?
Can we have volatility in the grains without war?
Yeah, that's what a guy would hope for.
Yeah. All right. Why don't you leave your number, John?
218. And definitely, beans were active in and suggesting, making recommendations. You're going to have to talk to us, and then we'll kind of go over them.
That's 218. A weird number.
Yeah. Yeah, it is. But I wanted to get that out there. There is one market that I really have my eye on. That's soybeans. 218-731-1578.
Thanks, John.
Sure. Bye.